Hi, everybody. Good afternoon. It's John Resnick at Efficient Advisors. I am joined by my colleague, Zach Shepard, and we're delighted that you have made some time to hop on the webinar with us this afternoon. We've got a lot to share with you. We're excited about this. And first of all, I just want to thank you for your partnership with us and the business that you do with us. We appreciate that. Our goal as we go through this is to give you an opportunity to see how we would present this to clients. This is a client-facing presentation. We'll get it posted out to the website as soon as compliance makes that feasible, but as quickly as we can. That should be within the week. As usual, this is not your first webinar. Everybody's muted to minimize the background noise. We will have time at the end for Q&A. We expect to be able to handle a few questions when we get to the end, but we won't be able to take them along the way because we're going to try and keep this thing flowing like you would present it to a client and post that out to the website as well so that you'd have an example on how to deliver it. Hopefully I'm not forgetting anything else that I should be saying, Zach. If I'm not, then we'll just dive right in.
I didn't hear anything that shouldn't have been said or didn't get said.
Okay, great. Let's rock and roll. So the title of today's talk is The Premature Death of Diversification. And on the tombstone, we kind of illustrated some of the earliest time when the idea around security asset allocation and the idea of diversification across broad asset classes essentially started around roughly 1952. And we're sad to inform you that it looks like it may have run its useful life as of 2024. So we're going to explore that as we go through the presentation today. If you'll indulge me, we're going to leave this slide in there for a second just so that you can all get a quick read through. There'll be a test at the end on the disclosures. So no, I'm kidding. This just helps us stay in compliance, which of course we always want to do. So I'm going to take the first part of this and we're going to spend a little time what we call slaying fallacies, investment fallacies specifically. There's 4 big ones we'll tackle as we talk through things today. What's a fallacy? Just a quick definition, a couple of quick explainers. It's a mistaken belief, especially one that would be based on an unsound argument. It could also be defined as a failure in reasoning, which renders an argument invalid. So we'll be looking at fallacies, 4 big ones as we go through here today. But as we always do, I want to level set first. So let's remember what we're striving for as we invest over time, right? Your investing lifetime is really about pursuing ideal outcomes, and everybody's ideal outcomes are a little bit different, but they all kind of boil down to managing these 4 things. The things we can control and some of the things we can't, but it's control them the best we can, right? Risk and return on the left. Of course, we would want risk and cost on the left. Of course, we would want risk and cost to be zero, but there's no such thing as zero risk, zero cost in a lifetime of investing. We're going to have to put up with some of it, but wherever we can, we want to minimize these things. So we want that arrow on the left going down. And on the right, of course, we want infinity return and 100% probability, which doesn't exist either, just like risk-free, risk and cost-free things. So we need to keep the arrow on the right going in the correct direction, which is up, with a clear understanding that over focusing on any one of these boxes exclusively is dangerous and potentially catastrophic to your wealth building exercise over time. We can't only let cost be the only driver or the primary driver, let's say, of an investment strategy, because think about where that could lead you. It's incredibly cheap to put 100% of your money in one stock, but it's horribly risky. So you misprice risk to your detriment if the only thing that you're going to do is focus on cost. By the same token, if the only thing that matters is return and we don't have any regard for risk, well, that's going to lead us to a dangerous place as well. So keeping these 4 things in mind and understanding that each one is affected by the other 3 is critical as you make your journey through your investing lifetime. A lot of what we're going to talk about today is really related to where the battle is. And the battle isn't actually in the 48 countries in which we're able to invest, right? Wherever stocks freely trade, you're going to own roughly 13,000 stocks in 48 countries in a diversified portfolio. And the challenge really isn't figuring out all of those markets or when to be where. The biggest challenge is, as they say, in the 7 or so inches between your 2 ears. So this comes from the Dalbar study, which comes out every year. We just got the new copy. And the average asset allocation investor, the typical person who owns both, let's say, stocks and bonds, the rate of retention, how long they keep an investment before changing it, fell to about 4.9 years, so less than 5 years in 2023. Over the years, we've seen this study kind of range between 3.5 and 5 years roughly, but most folks are changing things way more often than they should be. And the reason they do are kind of listed around the graphic here, right? You have these challenges that we face in the space between our 2 ears, where we have regret and the media and, you know, over optimism and loss aversion. Like, all of these things go into our decision making, and it makes investing more difficult, but we can't just turn them all off. So the real solution is to recognize they're going to be there and then deal with them, expect them, recognize them, see them coming from a mile away, and not let them affect our behavior in a negative way. So let's tackle the first fallacy, this factor fallacy. The S&P is outperforming everything. We should allocate more risk capital to it. Now that might seem like it makes sense. Like, recently, we've once again, we've hit new highs on the S&P 500. The S&P 500, again, is just an index of the 500 roughly largest U.S. publicly trading stocks. There's some that are U.S. publicly traded stocks that aren't in that index, but it's a general barometer of what's going on, right, in the U.S. stocks writ large. And recently, you would see headlines like this all over the place. In fact, if you've been doing this investing thing for a while, you've seen new record high closes many times in your investing lifetime, and likely you will see more, right? This benchmark finishes at its 22nd all-time high of this year as it's creeping higher and higher. And so it could be tempting to think this should be the only place we put money because it seems like it's the thing that's doing the best. In fact, you don't have to look very far to have people reinforce that idea.
But it seems like we're at a record for the S&P, right? And we're at a record for the equal weighted index as well. The NASDAQ 100 at a record. Here we go, guys, though, record after record.
Yeah, exactly, right? I mean, it just makes you look. I mean, we're looking at what, about a 27% jump in the S&P 500 since that late October level. So we have seen quite a run up.
Wow. Record after record after record, and a big run up since last October. So what happens if you decide, yeah, the S&P is looking awfully good, we should forsake diversification and just allocate more risk capital to it? Well, this is just a quick snapshot on the left of what the S&P 500 really means in terms of concentrating your wealth. It looks like you end up putting 31%, I'm rounding a little bit, in 10 stocks. So yes, there are 500 or so stocks in the S&P 500, but what's really happening is inside of those 500 stocks, there's an enormous concentration, almost a third if we round a little bit, in 10 stocks. And I'm not saying they're not great stocks. Of course they are. But this doesn't really pass the diversification test. This is actually more of a concentration exercise. On the right, you have an example of what a globally diversified stock portfolio would look like, where you don't have nearly as much concentration in the top 10 stocks, even though they're all there, right? The same names are there, the same great companies are there, but we just can't afford to concentrate that much risk in 10 stocks. Equally as true, we can't afford to concentrate that much risk in one country or one country's stocks. Yes, I'm aware that stocks in the US are companies that trade globally, and that the global economy and global capitalization and all of those things are different today than they were before. That's going to continue to be true going forward. I don't know how it'll change. We don't maintain a short to medium term outlook at all. But the reality is it's a dangerous place to be if you concentrate this much wealth in one place when wealth is really created all across the globe. At the end of March, right, global market capitalization in stocks across the globe where they freely trade was more like 61 to 39. And by the way, if you're scoring at home, 61% is actually creeping toward higher and higher, right? Our portfolios tend to hover about market weight. And the reason they do is because we can't afford to concentrate this much because it violates the diversification rule, and because we can't afford to guess. It's too easy to be wrong. The other thing we look at when we build portfolios and maintain them over time is how things look relative to other things in terms of price, right? So this is a little bit of a nerdy chart, but I'll try and just take the extremes to give you an example of what's going on here. This is our old pal, the S&P 500 index that we just looked at. And when we look at the relative price, how much stocks are trading for versus their 20-year average, we score that by price earnings. The S&P is trading at a significant premium, or it's much higher than, right? It's long-term average. The long-term average is closer to 16. It was recently trading at 21 in terms of PE. So that's a premium of almost 30%. The only way that this can get back to its average, well, there's really two ways. One way is earnings go up dramatically. I don't know what your opinion is about corporate earnings going up that dramatically, but the more likely way that things return to their average is by the price changing. You've got price and you've got earnings. That's the formula, right? So these are relatively, the red boxes are things that are asset categories that are relatively higher than their average historical price. And the green boxes on the other extreme are things that are actually below their long-term average forward-looking price earnings. We don't have any sort of inclination that we think that we should shift from one place to another to try and catch it at the right time, because that's a fool's errand and it doesn't work, and it's way too easy to be, you're way more likely to be wrong than you are to be right. However, if you had a choice, you had to commit to everything that's on the slide, right? The cheap stuff and the expensive stuff. I think you could all agree with me that it makes sense to stay committed to things that are relatively lower in price versus their long-term average, rather than overcommitting capital to things that are relatively higher in price. There's a philosopher that some of you may know who actually just boiled this down to the simple phrase: if you buy things that are relatively expensive and sell things that are relatively cheap, that doesn't make you an investor, just makes you an automobile consumer. If you don't know, that's a quote from my esteemed colleague, Zach Shepard, who I'm going to toss it to take us through the next section of the slide.
Thanks, John. I think we can all agree that we probably don't want to be automobile investors, as they don't make great investments in general. You may find a flyer every once in a while, but it's not likely. I think, John, you said you wanted to party like it's 1999, didn't you?
Yeah, I mean, that's kind of the illustration there, I would say.
Yeah, flash back to Game Boys and big cell phones, and we can all fire up our Napster accounts and illegally download songs and burn them to CDs. I did see a quote a little while back that said, at one point in time, we all burnt our last CD, but we had no idea that it was the last one we'd burn.
This is true.
Very true. But let's look. History teaches great, valuable lessons. And if we flash back to 1999, let's not forget what things were like. This article, or this Business Week publication, came out in May of 1999. And the headline says, "A wiser bull. Even if tech frenzy wanes, the stock market may enter a stronger phase." Now, interestingly enough, that headline sounds very familiar to something you may see today. Also, at the top left, you can see the Fed is still dominating the headlines, never stops, amazingly enough. But if you recall, just after this publication came out, the growth of wealth in the S&P did effectively nothing. It actually lost money for an entire decade. Like I said, history leaves clues. So the question is the S&P something that you really want to hold on to? Are you okay with not making any money over a 10-year period? And my guess is the answer to that is no. But that is the risk you're taking. History shows that this has actually happened. Now, the question I would ask you was this actually a dead decade? it was a dead decade if you were only focused on the S&P 500. But if you had a diversified portfolio globally, you actually had international large stocks and U.S. large value stocks, international large value stocks, and small cap in the U.S. and international emerging markets and U.S. small value, international small value. It actually wasn't a dead decade at all. While the S&P lost money for over a 10-year period, all of these other asset categories actually had positive returns. If you look at the very top line, 100,000 would have grown to $360,000 over this time period. But only focusing on the S&P 500 would have left you with negative wealth. If anyone doesn't know what this is the Morningstar Style Box. They publish this on a daily basis. It's the barometer of the U.S. market. And if you look on the right-hand side, this is growth. Okay. If you look on the left-hand column, this is value. And if you look across the rows, this is large at the top and small toward the bottom there. And this is just one day in the last week and a half or so. This is April 19th, 2024. And this is a day, my guess is a lot of investors who were globally diversified, they were very happy to see a chart like this, where small value stocks actually performed in the green at 1%, while growth stocks, large growth stocks, went negative 2%. And there's days like this all the time that happen. And I don't know how many of these happened during the dead decade, but I'm guessing there were quite a few. But the idea is we don't want to focus on just this area. And there are days like this where diversified investors count their blessings because they are diversified. But if you look at the S&P, and I understand why people are focused on the S&P so hard, because if you just look at the last year, the 1 year ending April 23rd, and you look at the exact same chart, check it out. What is the best performing asset category according to this chart? It's large growth, right? 28%. What do most investors do when things have run up really high and really well, and all publications are talking about new highs and this is a new paradigm and everything's going to be great? What they tend to do is they pile into the thing that's just done really well. They ignore the thing that they should be looking at is saying, okay, just because it's done well over the last year, has it done well over the last 3 years? Has it done well over the last 10 years, 20 years? What should we be looking at? What I don't understand when it comes to today is most people are talking about the S&P 500 and how it should be the only thing that they should be focused on, and everybody's getting great returns. And if you look at the last year, it was the best performer in this chart. But if you look at the last 3 years, ending the same date, it's not the best performer. And I would think you would all agree that 3 years is a very short time period when it comes to investing. If you look at it from this perspective, over the last 3 years, large growth has made really not anything at all. It's been dominated by large value and dominated by small value. These are the things what I don't understand is when investors think about just, and this includes that last year with a 28% return in the S&P. But investors tend to focus on just the recent past and make lifetime decisions that could be to their detriment by just focusing on that. Now, what's interesting from here is if you look at this chart and you think back 3 years, most of the companies that are dominating the headlines today, 3 years ago, were not large growth companies. They were value companies. Well, along the way, if you would have ignored that value component, you would have lost. You would have not had this. You would have not had this in your portfolio or any of these things in between. You would have focused on this. You would have had next to nothing. And then you would have been chasing and going for and chasing and chasing and chasing and continually making no money, probably for a decade. But those companies that dominate the headline today were actually located in this asset category. And this is the return that most investors, if you only focus on the S&P, they would have never achieved. Looking at the next chart, this is one of our favorites. And I know many of you are familiar with this chart, but this is called a Cowan chart. In other words, the periodic table of investment returns. This is since 2004. Now, this chart has, this is returns from best to worst along the left-hand side here, best to worst. And then from 2004 all the way through the end of last year. It's been updated. This is asset categories that include S&P 500, it includes international, it includes bonds, by the way. Most investors don't own just equities, they own bonds as well. And we'll talk about that in a little bit also. But the point of this chart is not to focus on the numbers. The point of this chart is to take a step back and say, okay, is there a pattern? Is there an asset category that we should be focused on in our portfolio that consistently and predictably is the top performer? The answer is, obviously, unless you're colorblind, the answer is no. The answer is this is extreme. It is random and unpredictable as to where returns come from, which asset categories they come from, and it's impossible to predict going forward which ones are going to be the best. Because the fact of the matter is, if we could focus on just one, the top of this line would be one color, and that would be the only thing we would own. That is just not something that we can deploy as far as a strategy that's effective. The point of diversification is to smooth out returns over time, reduce risk, and then try to increase the return by dialing things in. If you look at the next chart, this is the thing we're talking about. And if you look since 1926, if you look at stocks versus T-bills, or effectively cash, over 10-year periods, the market outperforms T-bills 87% of the time. Now, what can you do to dial that up even more? Well, if you look at the market and you divide it into value versus growth, there's components that we were talking about earlier. Value beats growth 80% of the time over 10-year periods, or has historically. Small versus large, a little bit lower, but small stocks have outperformed large stocks 68% of the time. And profitability, and just looking at the 10-year periods, because the reality is we don't want to look at 1-year periods as it is. This proposition of investing is the proposition of picking something, sticking with a strategy over long periods of time to increase the probability of success, as John talked about earlier. So if you look at dividing the market into these segments, and you start to look toward how can I dial my portfolio towards success versus just owning the S&P or just owning cash, you want to start dialing into these diverse categories. You don't want to focus on just one because, again, they can be extremely volatile, and you're likely, because of emotions, to blow it up. But if we start to dial in all of these things when it comes to our portfolios, then we can start to have some real success, potential success long term. Now, I'm not a statistics major, but I do believe that if I'm looking at probability of success, anything that is above 50% or greater over these long time periods are things that I believe we should focus on for our success. So the question then comes back to the beginning of the presentation, is this idea of S&P's diversification. We have 1952 on here because that's when Markowitz published his portfolio selection paper. This idea of diversification, is it actually dead? I think we look back over these past couple slides, the idea is absolutely not. The idea of diversification is not dead. What really we should be thinking about is rest in peace just owning the S&P 500. That's where we should be focused. The idea of just owning this one asset category is something that people will blow their portfolios up over time, and it doesn't likely give them the best route of success going forward. So that brings us to the next factor fallacy that we wanted to talk about, because, you hear these names that just dominate the headlines. The NVIDIAs, the Microsofts, the Googles, right? The Magnificent Seven they've been magnificent. That is true. Looking at the next slide, if you haven't seen a chart like this, this is called a heat map. And what this is representative of is this is the S&P 500. And the larger the company in the S&P 500, the larger that company is as a share of the S&P, the larger their box shows up on this. So as you can see, Microsoft, huge. NVIDIA, huge run up. Google, huge. Meta, dominating headlines. Apple, huge, right? These companies are the ones that a lot of investors are focused on, because this chart is representative of what their performance has been over the last year. Look at Microsoft up 42%. Look at NVIDIA up 200%. Look at Google up 51%. Amazon up 67%. These companies have absolutely dominated as far as returns over the last year. But the question goes back to price and what John's chart talked about earlier. What happens? There are studies out there that show that what happens to these stocks after they have really high run-ups? Do they continue to stay hot? And these studies show since 1927, this is the average annualized outperformance of companies before and after the year they become one of the 10 largest in the U.S. So before they become one of the 10 largest, they've done really well. The 10 years before, 11%, 20% 5 years before, 27% 3 years before. Really, really well. The question is, once they become the largest, what happens? And the first calendar year after they hit the top 10, these are their returns. Absolutely abysmal. So should we focus on these companies after they've had a really good run up? Are these things that we should be selecting and focusing on in our portfolios? Actually, there was a client that was talking to us the other day, John, I don't even remember this, but all they wanted to do was focus on the Magnificent Seven.
Sure.
And they didn't want it before that they had that incredible year after that the previous slide showed. They wanted it after. Now, here's something else that's interesting that coincides with this chart. So as we showed you the 1 year returns and the heat map of those stocks, check this out on the next slide. This is the 1 month ending the same time period. So Microsoft in 1 month lost 5%. NVIDIA in 1 month lost 12%. Slammed. These companies got slammed after they had that big run. Now, I don't know what these things are going to do over the next month and the next year. I don't pretend to know what that is. That's why we maintain that diversification is a key to success. But what I do know is that if you're focusing on these companies that have big run-ups, the studies out there show that the likelihood of them continuing that dominating performance is not very good. This is just that one, by the way, this is just that 1 day when we were showing you earlier, the style box for Morningstar. This is just the 1 day that was happening. NVIDIA lost 10% on April 19th. Just the 1 day.
Ouch.
While the rest of the market, now this is interesting too. You see all the red in here, and some of these big, larger companies dominating the red, where that large growth sector was down. But look at the rest of this chart. A lot of these companies in the S&P 500 were in the green. Now, and what most people, because of what the headlines were doing and because of what was being reported in the market that day, most people were like, oh man, I probably lost money that day. If you were diversified, it's likely you didn't. So rest in peace, diversification? We think not. How about we try the idea, rest in peace, trying to select the best stocks going forward, because it's dang near impossible.
Thanks, Zach. Yeah, thanks. So that leads us to our third fallacy, and this is one that has kind of become my pet peeve, or I can't unsee it. Once you hear this, you won't be able to unsee it either. So it's a phrase that goes like this: going forward, X should do better than Y because fill in the blank. And virtually every article you read in the financial media or talking head you see on TV or whatever seems to almost fit this pattern perfectly. Some form of this, right? But going forward, we know that going forward we should position this way. X should do better than, we expect X to do better than Y because some explanation, fill in the blank. Understanding, of course, that whatever you put in the blank hasn't happened yet, so it's essentially a prediction about the future. So breaking news, I don't know if any of you are aware of this, but it's an election year. and And it turns out that there's the temptation perhaps to think, well, going forward, it probably makes sense to de-risk or take some risk off the table because it's an election year and it's super volatile, and we would just things would do better if we just dialed down the risk or went to cash or maybe put more in bonds or whatever. Didn't have own as much in terms of stock. Maybe some of you have seen this chart before, but if you haven't, you don't need to really be able to read all of the fine print. But this is the presidents going back to 1926 at different administrations. The blue ones are Democrat, the red ones are Republican, and there's a general trend here overall. I don't know if you can see it, but it looks like if you can sit still and not freak out, it generally goes up and to the right? Like patience was rewarded, and people who tried to get the timing right, frankly, had way more chance to be wrong than they did be right. What about, well, going forward, if we have a mixed, if we have a Republican president and a mixed House and Senate or Congress, whatever, then that's more favorable for stocks or less favorable for stocks, whatever. Going forward, X should do better than Y because fill in the blank with whatever suits my mindset at the moment. This chart looks an awful lot like the last one. It kind of looks like it goes up and to the right. This is just sort of good old S&P index back over time to 1926. So it looks like the most important thing to do is sit still. But what about inflation? Now, we haven't seen a lot of inflation for a long time until very recently, and it went up dramatically, right? Like inflation has been scary. What is it? What's inflation? Everybody knows what inflation is because you've all been to the store buying eggs and meat and cheese and whatever else.
Those eggs are getting outrageous.
I know, I know, right? Gas, like it all goes in there. House price, home prices, it all goes into the mix. It's a general increase in prices, which the corollary to that is a decrease in your purchasing power, how far a dollar will stretch. Zach found a great video to explain this better than I ever could, and here it is.
Let's face it, the dollar just isn't what it used to be. That's why people like you and me, we gotta be careful to get the most value for our money. That's why I come here, Taco Bell. I can feed my whole family for $5.59. 2 tacos, 2 bean burritos, 2 tostadas, pintos and cheese, soft drinks, only $5.59. Like they're saying, Taco Bell. What a meal, what a deal. No kidding.
Taco Bell. I hope you're laughing as hard as I did the first time I saw that. Because, man, $5.59, that's,
was it
79? When was that?
Let me give you some social proof. So, he was feeding his whole family for $5.59 back in, I believe, 1980 or something like that. I took my family there on Monday, and it was 4 of us. Myself, my wife, 2 daughters, and our bill was $38.95.
That's more than $5.99, right?
So I couldn't feed my whole family for $5. So if you want to paint a picture painted as to what inflation is, it is that.
Yeah, it's just a crushing blow. I think of it, my word picture, you guys know I tend to be kind of a kindergarten level thinker, so I got to have a picture to make it all work. Inflation is essentially the river, and you're in it. We're all in it, and we're bobbing along. And sometimes the current goes faster, and sometimes it goes slower, but it's always going the same direction. That's what inflation is. And even if you can keep your head above water, right? You're treading water, you're in cash, and at least I'm not drowning, or at least the value of my portfolio isn't declining because I have cash, let's say. The reality is you're still going down river because that's what inflation is. And right now the current is higher than it's been in quite a while. So what should we do about it, right? Going forward, X should do better than Y because inflation. Well, we don't really find much evidence that makes sense to rely on, right? Will inflation hurt stock or stock returns over time? It looks like 22 of the past 30 years, stock returns were positive, even if you back out inflation. Over that same period, again, we're using the S&P as a measure here, not necessarily an investment recommendation. We've covered that. Annualized returns to the S&P are about 7.5%, adjusting for inflation. In other words, owning stocks is really looks like the most reliable way for you to be able to swim upriver regardless of how fast the current is going. So I guess we can't put an inflation an inflation prediction on our current strategy. We should rule that out. Well, what about interest rates? Maybe that's the thing that going forward, X is going to do better than Y because interest rates. Well, it's been a scary ride if you owned fixed income, and most of us do, right? Well, most of us own some portion of our portfolios in bonds. And when bond yields go up, obviously bond prices go down, and the opposite is also true. When bond yields come back down, as they have historically, then bond prices go back up, and you kind of get the trade-off of what happened when rates went up. So we saw this happen pretty violently, I guess you could say, from this chart in 2022 when the Fed raised rates, whatever it was, 4.5% or something, in a very short period of time. You can see now that the effective Fed rate is higher than bonds than 3-month Treasury bills at am I getting that right? 5-year yields at a constant maturity. So we're seeing the 3-month bills around 4.20, and inflation, or well, the Fed rate, which is about they're trying to get back down to closer to 3. But at the moment, the way they're doing that is by standing on the brakes, by piling on higher costs to borrow.
I do think what's interesting about that chart,
ahead.
Just to jump in here real quick, John, is that back in when this chart begins back in 2022, a lot of investors, all they were just wondering, how can I get, why are bonds paying anything? These bonds aren't paying anything. They're not yielding anything. We should abandon bonds, et cetera. And you can look at this chart, and they were yielding, the 5-year bonds, the Treasury yields were about 1.5% right at the beginning of that period, and the Fed rate was next to zero. But just take it out a couple of years, all of a sudden, bonds are now yielding something. The Fed rates come up because they're trying to combat inflation, right? And what that's done is raise the yield on bonds. So now bonds in a portfolio where obviously bonds will help reduce some risk when it comes to your equity risk and help you kind of stand pat. But now your bonds are actually yielding something. Now you're looking at bonds, these 5-year Treasury yields are at over 4%. That's substantial.
Yeah, when we didn't have much fun in bonds, we were all there with you in 2022. Remember, bond prices came down, right? Remember that when bond prices come down, if you can sit still, if you don't freak out, all of a sudden, like Zach said, now at least you're getting some yield. Let's say it's around 4%. Well, if your bond prices come down 8%, like the price of the bond, but your yield is now 4%, if you can sit still for 2 years and the Fed does nothing, even if Fed doesn't cut rates like everybody expected to have done already this year, they haven't, right? Even just pure earning your way out of the 8% decline, it's going to happen if you can sit still.
Exactly.
But what about stocks? What about interest rates and stocks? Should what's happening with interest rates really govern the decision about whether we're owning more or less stocks, or trying to get the timing of owning stocks right? And it looks like it doesn't make any sense to let that be the driver either. So on the right, you have stock returns when interest rates were higher than, or when interest rates were higher than average. Let's call that inflation, right? And then stock returns when rates were lower than average. And I know 1% is a spread, right? It's a pretty significant spread, but there's no way to get the timing right, or let either one of these things affect when to be in the market and when to be out, because you don't know, or when to have more stocks and when to have less stocks, because you don't know what's going to happen next really with interest rates. It looks to me like staying around average and standing pat, or staying committed to your strategy, is the most reliable thing to do. So is diversification really the thing that's dead? Again, we think not. Does it make sense for us to do this exercise and try and predict what to do next based on an unknowable future? Going forward, X should do better than Y because fill in the blank. I would suggest to you that we should get that out of your thinking and out of your lexicon to help you be a better investor over time. Dean, what about this one?
This one's, they came up with this one, John. This one's interesting, right? It's like things are just too volatile. Has anyone heard this? Things are thinking this. Things are just too volatile right now. We should wait for more favorable market conditions before we decide to invest in whatever it is we think we're going to do. Well, when do you think the market conditions are going to be more favorable? When do you think that they may have been more favorable over the last couple of years? So this next chart, this is kind of a walk through history here. This is the crisp 1 through 10. So this is every single investable stock in the U.S. market, and these are the annual returns from 1926 to 2023. So there's a couple things that are really interesting about this chart. One is, again, like we talked about earlier, if I'm thinking about statistics and I'm thinking about increasing my probability of success, then I probably want to look at things that are greater than 50%, right? So the positive years on this chart are 73 or 74% of the time the market is up in general. Not just the S&P 500. This is all investable U.S. stocks. The market is up 74% of those years, which means it's only down 26% of those years. Now, do we get to know in advance when those years are coming? No, we do not. In fact, you can look very recently, just the past couple of years, starting in 2018. That was a negative 5% year. So you may think in 2018, oh, the market's down. I'm going to wait to get into when things feel a little bit more certain. Well, look what happened. Immediately following that negative 5% year, up 30%. And that is a dominating year. I mean, that is in the top probably 10% of this entire chart.
Yeah.
As far as favorable annual returns. On the heels of a negative 5%. So even then you may be thinking, well, okay, I'm up 30% in 2019. This thing's raging. I should take put on the brakes, right? Well, what happened? Oh no, we just had another 23% positive year, right? Like
in the middle of a pandemic.
That's right. And if anyone recalls history that's on this call or joining us, in 2020, that was a year where the market was down in March, in probably the entire month of March was down 30 to 40%. And it still, if you would have stuck with it and you wouldn't have panicked and you wouldn't have done anything crazy with your strategy, it still bounced all the way back, including that downtime period, to have a 23% return for that year. So then you were probably thinking, well, you know what? It's done really well. We came off the heels of a pandemic. We're not sure what's going to happen with interest rates. Inflation looks like it may be coming because there's a lot of government spending during that time. What's going to happen the next year? We should sit on the sidelines and wait. Oh, no, it's just another 24% up year. Just that we'd be missing if we were waiting for the volatility to subside. But they don't all go up, do they? No, they don't. 2022, it was a down year, 19%. On the heels of those big up years, you're still doing pretty well if you stayed in. Now, we'll also mention that it wasn't just the market that was down at this time period. Bonds were down about the same.
Yeah.
Very similar. So there was nowhere to hide, right? So you're thinking, well, bonds are down, equity's down. What's going to happen? I should sit out and I should wait for this volatility to subside. Nope. If you did that, you'd have missed out on 26% up last year. So the point of this chart is you're just taking this walk, this quote unquote random walk, John, if you will. This random walk down the crisp 110. The market is unpredictable, and you can't take any individual year and extrapolate that out to know what's going to happen in the future and when you should get in and when you should get out. What this chart should tell you is that the market is up more than it's not. You should get in because you're likely to miss out on positive returns that will help you combat inflation and will help your portfolio grow over time. Well, what's the cost of avoiding the market? Well, in dollar terms, it looks like this. It's very real possibility that, over the next course of, 10 years or whatever it is, that if you're trying to time the market and you're getting in and out, it's likely you're going to miss the best week. Because the fact of the matter is the best week usually comes after the worst week. And if you miss the best week, this $1,000 that would have grown to 6,500 since 1999. This is the Russell 3000. Again, this is all investable stocks in the U.S. 1999 to 2023. If you missed the best week, you cost yourself $1,000. If you missed the best month, you cost yourself $1,200 on your $1,000. If you miss the best 3 months, you cost yourself almost $2,000. And then over $2,000 if you miss the best 6 months. The fact of the matter is, just like it's impossible to infer what annual returns are going to be based upon the past, it's also impossible to know when the best week is going to happen, when the best month is going to happen, when the best 3 months. But you better be in it. The fact of the matter is, you can be in it that entire time period and take down periods and still do better than just missing the best weeks. So don't try to time it. Well, but what about this one, John?
Yeah. What if we're hitting new market highs?
We're at new market highs. You just showed me the video early in the presentation. We're at a new market high. You know, I'm really nervous about getting in at a market high because we know markets are, you know, they do go down. They don't always go up. So what happens after new market highs? Well, going back to 1926 through all the way through 2023, the average annual returns after new market highs 1 year from the high is 13%. 3 years from the high is 10%. 5 years from the high is 10% annualized. So I think everyone probably would agree that, you know, the 10% number out 5 years, what that means is you double your money every 7.2 years, roughly. I think that if you could take that and look at it and say, I could double my money every 7 years. If I got in a new high and I could double my money every 7 years, I would take that bet. Would you, John?
Sure. Yeah, this tells me I don't need to wait till conditions are right if the market's open.
That's right.
Right? Right?
Yeah,
but
right.
what about if things aren't looking so rosy and you're not hitting new highs, you're actually in decline?
Well, yeah, I mean, because, you know, we do know that in any given year, and we know when any given year, we've done these studies too, that there's likely to be a 10% decline at some point throughout the year. We call that an opportunity to panic, right? So what happens to the market after a 10% decline, right? Should you wait for it to go further down? Should you pile in? Should you whatever? It does about the same as when it's at a new high.
Yeah, I mean, that's a rounding. Those two are within a rounding error of each other if you can put on 5-year goggle. Right?
So what you're telling me, John, is I don't have to pretend like I know if the market's going to go down 10% or if it's at an all-time high or where the bottom is. I can just get in and not worry about it. And it's about the
waiting for conditions to be right looks like it's a low probability thing to do. You got way more opportunity to be wrong than to be right.
But wait, so if the market goes up when it's at an all-time highs and the market goes up when it's down 10%, certainly during the, you know, over long periods of time with all these headlines and things that could drive markets and make and help you make decisions as to how the market's going to react. Certainly, you know, throughout history, there's been ways that you could avoid these things, right?
I don't think so.
So
doesn't look like it.
so look, this is from 1970 to 2023. This is all world markets. It's the MSCI World Index. This is all investable stocks in the entire world over this time period. $1 grew to almost $100, 100 times. And there were opportunities to panic all on the way, where the market was down 10%. There was the Arab oil embargo. There were oil prices quadrupling. The S&P was down 43%, 73.74. Headlines: the death of equities. Gold hitting record highs. Inflation. We don't hear about those things today, right? They don't talk about inflation being high and gold record highs. Yeah, we don't. That's weird. Black Monday, right? The savings and loan crisis. Iraq invades Kuwait, and on the heels of that, a war, right? Income taxes going up. Worried about? You hear about that? I just literally saw the headline the other day that there's a new plan proposed for income taxes to go up and capital gains taxes to go up, right? Certainly that would have an effect. Well, it maybe had a little blip during that time period, but if you look at the long period of time, it did absolutely nothing. Currency crisis in Asia. They don't have that today, do they?
Did you see Japan yesterday, the day before? Yeah.
I did. The Russian financial crisis, right? Y2K. All the nukes were going to go off as soon as the computers that they were programmed to hit 00. It was over. The .com crash, yeah, that was a scary time, and then markets did go down. But if you just didn't focus on what was happening during that time, and you kind of rode that out, and through 9/11, through hurricanes, another Iraq war, the subprime mortgage crisis, the S&P again being down 40+%, debt crisis, U.S. home prices hitting bottom, fiscal cliff. We'll never hear about that again, right? Brexit, COVID-19. I bet you look at the past, and I bet you look at this chart and you're like, oh man, I don't remember. I forgot that happened, right?
Yeah, some of this stuff is faded memory now.
And that's good.
Yeah.
Because but the problem with that is that we need to think about the now and the headline of now as this chart and the effect it's going to have. The reality is, if we would have reacted to those things along the way, we would not have turned $1 into $100.
Mm-hmm.
It would have been something far less. But if we just stop having our portfolio decisions driven by media and scare tactics and what's happening in the now, we can do fairly well. So should we kill this idea of diversification? Is it really dead? No, it's not. What we should kill is the idea that things are too volatile right now. We should wait for more favorable market conditions. It's always going to be volatile. There's always going to be news that's going to seem daunting. That is going to be the case. But waiting to get in and stay in and stick to your plan and maintain diversification, that's the thing that's going to take it to the grave.
Yeah, that chart was just full of reasons to keep waiting, and if you did, you didn't get the up and to the right. So let's see if we can wrap up everything we covered. I know that was a lot in a short period of time. Thanks for playing along with us. Just a couple of parting shots, I guess, are the 4 big things we wanted to talk about in terms of slaying fallacies. And here they are, right? Just this is advice you should take with you across your investing lifetime. Avoid strategy changes that assume the current anomaly, whatever it is, will continue indefinitely. Diversification demands discipline. It can't work for you if you abandon it. The only way it works is if you stick with it. Avoid the temptation to subsidize the fear economy, right? Panic pays no premium. We have another great presentation on that specifically, but the fear economy is the everything else you see and hear and watch that's constantly giving you a reason to potentially abandon your strategy or question why diversification makes sense now and always. So let's just avoid the temptation to subsidize that by giving it brain time. Let's avoid building your investment strategy on the unlikely. We've talked a lot today about what seems to be the most probable thing to do, even though we don't know what the future is, and that the only thing that moves prices is random and unknowable information. Let's remain intellectually respectful and understand, knowing that markets and time will have a way of humbling us along the way. So it's fine. Understand that there will be bad periods, and the only way to get through them is to stick with it. Lastly, let's avoid an investment strategy that requires getting the unknowable future correct in advance. This is the X is going to do better than Y because fill in the blank. Just understand and embrace the notion that successful investing requires an unwavering commitment to the unknowable future, including things that at the time are labeled unprecedented. So with that, we'll wrap it up here. I'm going to stop the recording and we can do a little Q&A here. 1 second.